What if I told you that one poor investment choice could cost you $8 million in missed wealth? That's exactly what happened when we compared investing $100,000 in SCHD versus VTI over 30 years. Our simulation revealed a shocking difference. One fund grew to $4.7 million, while the other reached only $2.7 million. The dividend comparison was even more startling: $375,900 yearly versus just $953 annually. Today, I'm revealing which ETF wins this investment showdown. Plus, I'm introducing a mystery third option that outperforms both funds by a staggering $8 million. This hidden alternative could completely transform your retirement strategy. Ever wonder what happens when you put $100,000 in the wrong investment? One decision can mean the difference between financial freedom and working an extra decade. That's exactly the problem facing Leo the Lion right now. Meet Leo. He's a 35-year-old marketing professional who just received a $100,000 inheritance from his grandfather. Growing up watching his parents struggle financially, Leo dreams of retiring early and traveling the world. Now, with this windfall, he's narrowed his options to two popular ETFs, SCHD and VTI, but can't decide which will better serve his goals of both reliable income and maximum growth potential. "I keep flipping between options," Leo told me. "Some days SCHD seems perfect, other days I'm convinced VTI is better. Making the wrong decision with my grandfather's legacy terrifies me." What makes Leo's choice so difficult is how differently these ETFs operate. SCHD, the Schwab U.S. Dividend Equity ETF, selects about 100 high-quality dividend stocks, an elite team of consistent performers. It prioritizes companies with at least 10 years of reliable dividend payments and strong fundamentals like Coca-Cola, Home Depot, and Pepsi. Meanwhile, VTI, the Vanguard Total Stock Market ETF, takes a completely different approach by owning over 3,600 companies across the entire U.S. market. From tech giants like Apple and Microsoft to tiny startups you've never heard of. Their growth mechanisms differ significantly too. SCHD builds wealth through regular dividends, which you can reinvest, plus price appreciation as stocks increase in value. VTI, while paying some dividends, primarily relies on stock price growth to build wealth over time, with nearly a third of its holdings in technology stocks. SCHD charges 0.06% versus VTI's 0.03%, Leo points out. That's double the cost. Will that hurt me over 30 years? It's a valid concern. On his $100,000 inheritance, that's $60 versus $30 annually in fees. Over decades, this difference compounds, but these small fee differences become relatively minor compared to choosing the ETF that aligns with his actual goals. The real question isn't about saving $30 a year. It's about whether Leo prioritizes steady dividend income or broader market growth potential. The true cost to Leo isn't the expense ratio. It's potentially choosing an investment strategy that doesn't match his financial timeline and objectives. A few basis points pale in comparison to selecting the ETF with the growth mechanism that truly fits what Leo hopes to accomplish with his grandfather's generous gift. Those small differences in fees might seem important, but they're nothing compared to what happens when the market takes a nosedive. What if I told you that choosing between SCHD and VTI could mean the difference between losing a third of your money or more than half during a market crash? Let's peek under the hood to see what really drives their performance during good times and bad. When we look at the actual composition of these ETFs, we're talking about two completely different investment animals. SCHD's top sectors create a unique risk profile that stands apart from VTI's approach. Financials make up 20.3% of SCHD, followed by healthcare at 15.1% and consumer defensives at 14.2%. Compare that to VTI, where technology dominates at a massive 28.5% of the portfolio. This sector allocation fundamentally changes how these funds behave when things get rough. Think of SCHD as a well-built fortress, while VTI resembles more of a roller coaster ride. During major market downturns, SCHD has shown a maximum drawdown of negative 33.37%, while VTI experienced a far more painful negative 55.45%. In the worst-case scenario, VTI investors lost over half their money, while SCHD holders preserved significantly more capital. The 2008 financial crisis illustrates this perfectly. When markets were in free fall, SCHD's focus on established companies with consistent cash flow provided a real buffer. Meanwhile, VTI felt the full force of the collapse due to its broader exposure to companies of all sizes and stability levels. During the 2020 COVID crash, we saw the same pattern. While both ETFs took a hit, SCHD investors continued receiving dividend payments throughout the downturn. There's something psychologically powerful about seeing cash flow into your account even when market prices are plummeting. This stability shows up clearly in the volatility numbers. SCHD has a volatility measurement of 3.1%, while VTI runs hotter at 3.46%. For Leo, this difference means fewer dramatic portfolio swings and potentially fewer sleepless nights worrying about market fluctuations. Of course, there's always a trade-off. SCHD's focus on dividend-paying stalwarts means it misses out on some explosive growth opportunities. VTI captures potential moonshots, which can drive returns during bull markets. But remember, VTI's embrace of the entire market means it also holds the eventual losers. SCHD's quality filter helps screen out many of these troublemakers before they can damage your returns. The real question for Leo is which approach better matches his personal risk tolerance. If maintaining wealth during downturns and having regular income matters to him, SCHD's more resilient approach might be worth the potential trade-off during strong bull markets. While stability during market crashes matters, Leo's wondering about the ultimate question: which ETF actually makes more money in the long run? The historical returns tell one story, but when we add in the hidden power of reinvested dividends, one of these funds transforms $100,000 into a wealth-generating machine that outperforms by nearly $2 million over 3 decades. Let's look at what the numbers really show. In the past year, SCHD delivered a solid 8.88% return, while VTI achieved an impressive 21.47%, more than double. Based on these recent figures alone, VTI looks like the obvious choice for Leo's inheritance. But smart investors know that 1 year tells only part of the story. Looking at a 5-year window, we see the same pattern. SCHD grew by 45.74%, while VTI advanced with 79.6% growth. Even over a decade, VTI maintains its lead with 178.77% return compared to SCHD's 114.37%. That's the difference between doubling your money and nearly tripling it. At this point, Leo might wonder why anyone would choose SCHD when VTI consistently outperforms it. This is where many investors make their critical mistake. They're looking at only half the equation. The game changer is dividend reinvestment. Think of dividends as seeds that grow into new money-producing plants over time. When we account for both price appreciation and dividends automatically reinvested to buy more shares, the picture transforms completely. This compounding effect turns good investments into wealth-building powerhouses. Let's run a 30-year simulation of Leo's $100,000 investment. With VTI's 1.24% dividend yield, combined with its 10.88% annual appreciation, his initial investment would grow to approximately $2,649,400. Impressive, right? But SCHD reveals something remarkable. Despite its lower price appreciation of 7.69%, its higher 3.59% dividend yield creates a compounding effect that's nothing short of extraordinary. After the same 30 years, Leo's $100,000 in SCHD expands to $4,613,336, almost $2 million more than VTI. The income difference is even more striking. After 30 years, VTI would generate just $953 in annual dividend income. Meanwhile, SCHD would produce $375,900 in yearly dividends, over $31,000 every month without touching the principal. This transforms Leo's future options. With SCHD, he could potentially retire with monthly dividend income exceeding his current salary. He could travel, help family members, or support causes he cares about, all while his investment continues growing. With VTI, he'd need to sell shares regularly to match that lifestyle, gradually depleting his principal. The choice between these ETFs goes beyond historical performance. It's about understanding how compounded dividends build wealth over time. Despite VTI's stronger price appreciation, SCHD's dividend advantage creates substantially more wealth over the long term. In the end, your ETF choice boils down to what matters most on your financial journey: steady income or maximum growth potential. But here's the twist. There's a third contender that could outperform both by a staggering $8 million over 30 years. For growth-hungry investors, QQQ presents an exciting alternative. And if you want to optimize further, QQQM offers essentially the same investment strategy, but with a lower expense ratio, keeping more of your hard-earned money working for you, as those saved fees compound dramatically over time. Before making your final decision, ask yourself, will your ideal future be built on reliable dividend income, broad market growth, or potentially explosive returns? The power to transform your financial future is in your hands.